You might have heard of a gamma flip. Well, I wrote about it in 2019, published it, but it's not really new. It's just those who are in the know. But have you heard of a gamma prison? If you're interested, stay tuned. Welcome, fellow investors, speculators, and traders. Today I want to talk to you about options, deltas, gammas, gamma flips, and I think I made that up. Gamma prison. Well, at least I Googled it and nobody has used it before. So forgive me if you came up with that phrase first. I'm going to shamelessly use it here. Why am I doing that? We are going through OPEX right now and markets trade in a certain way. We have all the same news. We have all the same charts. So if we have all the same information, what new impulse actually can come into the markets? And that's what I call market mechanics. That is the thing those who have to trade have to do. You have probably heard, I don't have to do anything. Well, if you're a market maker and you have to hedge your positions, you have to do at certain points certain things. And that can move markets or make markets stand still and don't do anything. So what we're going to do today, I'll run you through briefly what is a gamma, what's the effect of a gamma, and then what we have seen in recent, well, let's say in the last 15 days, because you actually could spot it at the market, what was most likely to happen. There is no certainty. And we also have a good idea what might happen next when the jailbreak out of the gamma prison will happen. I hope you enjoy, and I go now over to the presentation. So, let's look into the gamma flip and gamma prison. Market mechanics, influence on market behavior and volatility. Who am I? Quick introduction. My name is Thorsten Roland Wegener. I'm retired. I'm a Uber driver for my children. I'm a chef. I'm a, homemaker. And obviously I am retired. I used to be a market maker. I learned it after I left university at West LB, which used to be one of the largest banks in Germany at the time. I eventually was promoted to become chief trader, took over the head of trading for the warrant and structured product business, then moved over to London, became head of equity derivatives at Penmuir Gordon and Company, which was one of the fine small investment banks in the UK at the time, and finished my career as a partner at Bear Stearns, responsible for head of securitized equity derivatives in the UK, Germany, Austria, and Switzerland. So let's get into it. So you know I might have an idea what I'm talking about. And let's have a look at this marvelous slide. What does it tell us? I'll run you through. It actually shows you how the positioning of market makers requires certain actions, and we can spot these footprints as open interest on our trading screens. That has influence on the market behavior, what's going to happen, most likely going to happen, and the volatility of the market. Let me run you through. If you're more interested in the gamma flip, the first part, I have a video about max pain trades and gamma flips if you can speak German on my channel, which is bilingual. But this was a little German video I recorded to clear up the myth that the max pain trade is not what a gamma flip is. Max pain is what is loved by retail customers, but I don't think too much of it. But you can have a look at that and get demystified about some of the, stories being told about what happens on option expiration. What is a gamma flip? I published that in 2019 at my friend Bilal Hafiz, who was running Macro Hive. And funny enough, that was one of the articles I wrote, which was even picked up by Market Insider and by Zero Hedge and by a couple of other publications out there. People like that. But markets has moved on. We are 6 years later now, and I think people have heard about gamma flips and the effect of gamma, as there are more and more providers also on the market to give you a good idea where to find the gamma levels, how to spot it, and maybe what to do next. And that's what we're going to do now. So what is the gamma? Effects on the buyer and seller. let's have a look here at the gamma distribution of put and call options. Gamma call options at a certain market level. That's an old example I have here. It simply says, okay, we have call options standing here, and this is a call option which has a strike, let's say 490 on the SPY. And you already see the moment you cross that threshold at expiration, that's the potential profit you're going to make. In the meantime, we have days to expiration. This thing lives. And when you own a call, you have this fantastic property that when the market goes up in your direction, you become more long. Your delta is increasing. Why is your delta increasing? That is the so-called gamma. The gamma always adds on delta. So you start at the money with a delta of 50, which is 0.5, because we trade 100 contracts in one option. It's 50 delta, that's what it's called. And if the market goes up, suddenly you earn, if the market moves $1 in the first instance, you earn 50 cents. And then the market moves further into the money on this side, and you earn more with every dollar the market moves up. You earn 60 cents, 70 cents, 80 cents, until eventually, when you're far out deep in the money, you will make on your option $1 when the market moves up $1. So this change from 50 delta to 100 delta when we're deep in the money is generated to your gamma. So that is extremely positive. What happens when the market goes in the other direction? You start with a 50 delta, and then you are less long suddenly. You suddenly only long 40 delta, 30 delta, 20 delta, till eventually you lost your money. The call option is worthless. However, this property that when the market goes in your direction, you're more long, and when the market moves against you and you're less long, has to be paid for. That's why you buy an option and you pay a premium. It's a time value. So somebody who spends this money should use this characteristic I just explained to hedge their positions. But do retail customers or institutional customers for that purpose actually hedge their positions? No, they don't. They buy a call option or they buy a put option because they think the market will go in their direction and they can benefit dramatically because of the leverage factor through these things. But who are they buying this from? They're buying it from market makers, from dealers. Here's the put option as the other example. It's pretty much the same. The market goes in your direction. You're along the put option. You become more short on the way down and you become less short on the way up through the negative delta you have in here. And again, it's the gamma, which makes your short delta bigger on the way down. You're more short, market falls, that's great, that's what you have. And the market goes against you, you are less short, also beneficial. And for this, again, you have to pay a premium. You pay this premium to the dealer, to the market maker. And you're most likely somebody who's going to hedge your portfolio or has a great trade idea. And in the meantime, you buy your options, you sit on it, and you wait whether things turn out the way you expected them. They make a huge profit or they end up worthless. So how's the dealer positioning in that case? And because that is interesting for all of you to think, what are the guys who have to manage their positions, who have to hedge their risks? What are they going to do in the market? For example, we have here a dealer long gamma, right? Why is the dealer long gamma? This looks like a call. You remember the first slide? Because customers usually sell calls to me as a dealer and buy puts to hedge their positions, and they buy these puts from me as a dealer, right? So here's a short put. That would be my position as a dealer. Market goes down. That really, really hurts me. So I have to do something against it. And markets go up. That is great for me because I own the long call option. Great, that's fine. And I've sold the put option to the customers out there because they want to hedge their position. If the market falls, bad for me. How's my gamma position? When I'm long an option, I'm always long the gamma. So the beneficial part I explained earlier works for you. The market goes up and you're more long. So what do market makers do? Obviously, as a market maker, I have to show bids and offers. I'm not interested in any directional ideas of the market. A customer asks me, would you sell me a put or a call? And I say, fine. And they might even ask, give me both sides of the price. Make me bid and an offer. So I don't know where he goes or she goes. I just make a price and the customer eventually trades on it. But what they usually have in their books is this position, because most of the people out there, institutional investors, private investors, own stocks. Yeah? They have a portfolio of shares. So let's assume you have a really good stock position, you made a fantastic profit already, and you want to squeeze out a little bit more. At the same time, you don't want to lose your money, your profits you made. Well, how do I finance that? Well, great. Let's assume the market is at 100. You sell a call with a strike price of 110, get some money for that. That money that goes into your pocket will be spent by you on a put further out of the money, a little bit further down, so that you can use this premium. All right, so you're protected on the downside and you have potentially given some upside away, but even though you have given some upside away until you reach the strike, you still make money, and then eventually I will call the stock as a market maker if we go above this threshold. Right, so I pay option premium and I receive option premium as a market maker. So what happens in these situations? The dealer gamma distribution is gamma and liquidity. If the market goes up, as I'm not interested in having any directional position, I own a call option. How do I hedge myself? Well, I own a call, so I participate when the market moves up, so I have to sell stock against that. And what we sell against it, we call it delta neutral. Yeah? We're trying to keep our delta at zero. Simplest example, I have 100 deltas long because I own a call option, so I sell 100 deltas through a stock against it. My position is neutral. Now the market goes up, and suddenly I get more deltas. The call option I own, yeah, I have the gamma. Suddenly I'm a little bit more long again. I make money on the upside. Great, but I don't want to take a directional risk. So what do? I start selling shares against that. I provide liquidity to the market. So what happens when somebody provides liquidity to the market? Does volatility go up or down? Volatility goes down, right? There's always somebody, if the market is foaming and everybody has FOMO and wants some shares, and I'm, as a dealer, I'm gamma long, I own the call options, yeah, I can say, fine, I'm delta long again, which means I want to be neutrally hedged, I can sell more shares to you. When there is more volume coming into the market, means volatility goes down. That's why we always see in a rising market, usually, you never say always. That's why we see in rising markets volatility come down, because as a market maker, I most likely have this position on, like all my colleagues in all banks in the world, because customers love to do that. They sell calls to me and they buy puts from me. So what happens on the downside? I'm very long as a market maker because I'm the put short, right? And I'm also gamma short, which means on the way down. When I explained it at the beginning, if you own the put, it's great. On the way down, you become more short. Yeah. All right. On the way down, as a market maker, as a dealer, I become more long. What does happen when I become more long? I have to hedge myself. Yeah. I'm delta long. So what am I going to do? I'm going to sell shares against that. But the market is falling. Everybody wants to sell shares. And on the way down, I get short a longer and longer and longer. So I have to keep selling, which means I take liquidity away from the market. There might be buyers out there who think, oh, that's a bargain, I'm going to get that. And the other institutional client wants to sell into his bid. But now suddenly I'm there, crowding the market. Like I did on the upside, now I'm doing it on the downside. So volatility will increase in this situation. And this is from an early example, what I mentioned at the beginning, the max pain. That's what the retail customer always thinks. Market makers are manipulating the markets to actually let puts not get into the money. It's all big BS, but watch the German video. I link it over here if you speak German. And I make an English video about that topic at some other date. And then we have here the gamma flip, because as this is my position, I'm long the calls, I'm short the puts, I can add all these gammas up. On the upside, you can see here, I'm long gamma. This is positive for me. If I have long gamma, I can provide liquidity to the market. Volatility goes down, and the market is not shooting up. There will always be a market maker who can say, okay, fine, I have some shares available for you. You get them in. The direction is still on an upward trajectory, but not as dramatically as that is. That's, by the way, if you see volatility increasing in increasing markets, that's a surefire sign that this relationship this time is different, yeah? That the market makers are short the calls and they have to buy on the upside. Don't want to confuse you. Just as an idea, in normal situations, this is the book I will hold as a market maker, and I'm required at certain levels to do certain transactions. What can we see here? The further the market goes down, yeah, I'm more and more gamma short. But eventually, my short gammas will cease to exist because gamma is always the biggest at the money, where the options are. If that is here the strike, and these are the majority of options been sold, you see we've already used up a lot of our gamma. In terms of the mass under the curve, that's probably a third already we have used up here. When we come into this region, you can say, fine, if the market makers are not longer forced to sell into a falling market, yeah, their short gamma has been exhausted. What's happening then? You find a market bottom. That usually happens when volatility is the highest, when volatility comes back a little bit, and you can see on your screen, oh, there is not a lot of open interest on the downside anymore. You might have reached a temporary bottom. Yeah? So we have the flip here. That's the gamma long position as a market maker on my book. That's where I provide liquidity to the upside, take volatility out of the market, and make it stickier to go up, right? And here I'm gamma short, which means I make the market move into the unfavorable direction because I have to take liquidity out of the market. Suddenly I'm a seller like everybody else. There is more selling in the market that will reduce prices or potential buyers to take them up, and volatility will go through the roof. So what does that tell us? Let's have a look at the current situation we had here. We see a gap in the market that was President Trump's tariff talks, where he reduced the, ridiculous 150, 160% of tariffs down to reasonable 30 again when the negotiations with China started, and the market took a huge gap up. So this is already the expiration we have actually tomorrow. I'm recording that on the 19th of June. So what happened? What could you see in the market? You could see in the market the following. 5,900 was a strike price where the market makers in this case were long gamma. Yeah? They had long call options at the strike of 5,900. Why is that? Because after this decline in the market, a lot of long-term holders thought, okay, let's get some extra money in. Let's sell some calls on top of it. We probably don't see that super fast reaction, so I can make some extra money by selling call options. And who's going to give me a price? The market maker. So we could see this on our trading screens in terms of open interest. 5,900. The guys who have to trade gamma were long gamma. And what we could also see, 6,000 was also one of these levels where clients have sold a lot of call options to market makers and dealers who have to manage their gamma. Why? Because I pay a premium for these calls, yeah, to my customer. The customer pockets a premium. I have to earn this premium. How can I earn this premium? Through gamma hedging, yeah? Delta hedging we call it. That is, I'm scalping my gamma, which is market makers know what I'm talking about. That's how we hedge our risks. That would go a little bit too far here now, but it simply says if the market goes up, I have to sell. If the market goes down, I can buy. And that's exactly what we've seen here. I put these lines in, 5,900, 6,000, and 6,100. Do I have it in here? No, I don't have it in here. Oh, yes. That was the next level where market makers were short again. How did that come? Well, you might have heard something of a call spread. Yeah? Speculators go in and say, okay, the market is here. I'm going to sell, let's say, the 6,000 call, but I'm not sure if the market really goes through the roof. I want to be hedged, so I can at maximum lose 100 points here. So I'm selling the 6,000 call, and I'm buying the 6,100 against it. So the two green lines is market makers being long. The pink line, I chose pink, is market makers being short. The biggest volume was here on the middle line. We had, up till yesterday, 250,000 contracts at 6,000, and we had a little bit less at 5,900 a little bit earlier, and then we came into this expiration week. And gamma, when we are at the money, is increasing dramatically. Yeah? If you're at the money and you're moving into expiration, your gamma is getting bigger and bigger and bigger. Great. If you're long gamma, which means you can provide more liquidity to the market. And that's exactly what happened here. We had this gap to the upside. Why didn't the market completely recover straight away? Because there were 5,900, a lot of market makers who were able to give liquidity into the market. So around the 5,900, as a market maker, I was able to sell to the upside and buy to the downside. Gamma works both ways, right? So I kept the market in that threshold. Then we moved eventually to our 6,000 level, and then we saw exactly what happened right now. We are extremely difficult to have this breakout here. Yeah? 250,000 contracts long, mostly by market makers on the 6,000 level. They can provide liquidity. So they have been rolled last week or disappeared. They're out of the market now. So we have been in this lovely little jail in here, where there was long gamma here and long gamma here and short gamma over there. But these positions, because the market makers had a lot of long gamma on their books, actually blocked the market in. Now, let's have a look at the gamma prison and the jailbreak that eventually will happen. These were the strikes I just mentioned, 5,900 to 6,000. And obviously gamma is not only at these levels, it has variations to the upside and to the downside. So we stuck roughly in this box, and now there's expiration. And we do not have the short gammas at the moment anymore. What might happen, or might have happened, a lot of customers might have rolled that into the next July expiration, or they moved even up to 6,100, 6,200, 6,300. So these are all new spots for you to have a look at. But what we could see and what was happening is that the market lost volatility because market makers were active hedging here, hedging there, and kept the market in this pretty narrow range. Volatility came down again. And from Monday on, there's a new game on. There might, over the weekend, come more news from the White House, from whatever's happening at the moment. And you will have to have a look, how's the open interest developing in the future to do this game again. Just keep in mind, gamma is the largest when we're going to expiration, when volatility is relatively low, because it's leading also to relatively low volatility in here. And when we're at the money. When you spot this, you have a pretty good idea what might not happen. And our idea, and this time it proved right, obviously nothing is for 100% certain, but we anticipated that we would be stuck in a trading range and that 6,000 would be one of the toppish levels. We might overshoot a little bit, other points come in, and there's a liquidity level here. We touched that once, went down again. So the prison held, and now it's expiration. Tomorrow, it's over. The options go out. What happens after? The prison held, the walls of the prison held quite well, and then we have a prison break. The question is, where are these contracts rolling? Are they moving at the same strike levels to the next month? Then you have the same situation. You have gamma, but this gamma is suddenly smaller. So if overwhelming news to the upside or downside could come in, that could be a real jailbreak. Also, a lot of steam has built up here. If we see a move, a dramatic move, and gammas are not there to accelerate or decelerate the move, then you could say, you have a case for momentum. If we see a breakout, then it could be a larger breakout. To the downside, I would expect that we go down to the levels of 5,750. If we go to the upside, we're trying to take new all-time highs, and when we have new all-time highs and some good news come out in the market, then we're pretty fast at 6,400, because there are also a couple of short strikes in the market by those who have to hedge. That would be me as a market maker or as a dealer. Suddenly the market goes up and I have to buy. So I'm flaming the fire in this situation. So sum it up, have a look on the open interest, look at the levels where we are, look how much volume or open interest is in these contracts which are due to expire, and you get a pretty good idea what the market is does. For confirmation, look at volatility. If volatility goes down, which means a lot of market makers are in there dealing, and when this whole OPEX cycle is over, then things might start moving again dramatically. Also keep in mind, second half of June is usually weaker because we don't have any stock repurchase in preparation of the next earnings season, and seasonally we've tested that back to the 1990s. Second week in June always, or second half of June always looked a little bit weaker. So that was the brief lecture on gamma. You can read this article about the gamma flip actually on our website. It's the tactical brief. It's in English, kindly provided by Bilal from Macro Hive, where I published it to give you a little bit of an explanation what I try to do in this video, and you can reread it. And then I have a couple of recommendations. Recommended readings of a market maker. If you're deep into options, you have to have this book, obviously, Red Option Volatility and Pricing, Sheldon Nadenberg. When you start in our industry, it's get thrown on your table. You have to read it. If you want to get into the nitty-gritty bits, Models on Models, Espen Gardner Haug, fantastic read. And if you want to have an entertainment bit, A Random Walk Down Wall Street, simply complexity and misbehavior of markets are the go-to books you need to. If you need a book with formulas for options, option pricing formula, Espen Gardner Haug, and dynamic hedging, pricing, hedging, trading exotic options is also, which gives you a deeper understanding how markets work and how they influence, or how option markets work and how all the Greeks we're working with and all the volume and liquidity traded there is influencing the market. Thank you for your attention. If you liked the lecture, please like, share and comment, and I promise I'm going to do more videos in English for our international audience. Here are the risk disclaimers. I just slipped that in. I like to do that. Everything I do is not trading recommendation. It's not investment advice. I'm not an investment advisor. I don't have a license to do that. Therefore, I called it a lecture. That's what it is. I want to give you a little bit of the know-how I acquired over the 30 years with my colleagues in the past. What might happen on certain points in the market, at least where to put an eye on. I hope you enjoyed that little bit, and I see you soon on this channel. Bye-bye.